Welcome back to the Lightbulb Series by Valkyrie Investments, where we cover crypto topics requested by you in 5 minutes or less. Today, our head of ETF portfolio management, Bill Cannon, will be covering ETFs.
Hi, I'm Bill Cannon, ETF portfolio manager at Valkyrie, and I'm here to give you a brief introduction on futures-based ETFs. For this discussion, I'll be going through the mechanics involved in futures ETF management, hopefully providing some insight into participants and process involved. Last week, I ran into my neighbor on my daily morning walk with the dog, and she mentioned she didn't know how to get into Bitcoin and thought it was already expensive from what she was reading, and she felt that she missed her chance. At that moment, I explained how ETFs work really quick and how she can be able to purchase shares through her brokerage account at home. It's an easy process, and in reality, it's not that expensive to get into. So let's start what an ETF is. An ETF is an exchange-traded fund that tracks index, sector, commodity, or other assets. Each ETF is built into either an index, like standard equity indices like the Dow Jones or the S&P 500, or built to track a specific commodity or asset like Bitcoin futures. Similar to ordinary stocks, ETFs are exchange-traded, which provides simple accessibility to all types of investors, depending on their investment strategy and appetite for risk. So why a futures ETF for Bitcoin? Bitcoin futures ETFs hold Bitcoin future contracts rather than the cryptocurrency itself. Future contracts are regulated financial instruments that allow participants to assume the risk of price change of the underlying asset over time. In contrast, the actual Bitcoin currency is not regulated yet, and the timing is unknown at this moment. Futures contracts are efficient, allowing buyers and sellers to easily enter and exit the market. If an investor expects the price of Bitcoin to go up, they could buy a Bitcoin future and assume the responsibility of price changes over time. Bitcoin futures track the price of the Bitcoin reference rate, otherwise known as the current or spot rate. Futures closely mirror the price of movement of spot. Derivative products like futures and options are traded at the Chicago Mercantile Exchange or the CME. The exchange provides market participants a regulated, safe, transparent, and balanced trading platform. So why ETFs for Bitcoin and not buy actual Bitcoin itself? One word answer, trust. Many investors prefer and have waited for a crypto-related structure to be listed on a stock market and approved by the Securities and Exchange Commission, or the SEC. ETFs provide an easier way to gain exposure of Bitcoin into their portfolio, which can be purchased with a simple click of a mouse. These investors prefer paying a management fee for the ETF and become comfortable knowing this market is regulated, a small price to pay for security. Conversely, holding actual Bitcoin currency involves a process of using software, securing passwords, signing up a crypto broker, and transferring the Bitcoin into your blockchain wallet. Although it's not difficult, this involves a good deal of required maintenance that may not be for everyone. I should mention one risk that exists that could affect fund performance. It is related to the monthly roll process. This process involves rolling off or selling current month contracts and rolling into or buying the following month. The small price difference between two contracts usually causes a small negative impact on the fund. Current investors feel the actual performance of the fund outweighs the small price of the rolls due to security reasons related to involving regulated vehicles at a regulated marketplace. We feel this is negligible in the long run with improved liquidity and increased market participants anticipated to enter this market. In summary, the fund managers maintain the Bitcoin futures position to accurately track the performance of the underlying Bitcoin value. How are ETFs introduced into the marketplace? To simplify a complex process, ETFs are created and redeemed by authorized participants, or APs. APs are usually the name brand banks that everyone knows. The ETF distributor and the AP work together to facilitate the creation and redemption of ETF shares based on the needs of the market maker. Enter the market makers, who are the guys that basically get these shares into the secondary market. They are permanent liquidity providers that provide a two-sided market and connect the ordinary investor via brokerage accounts to buy and sell ETFs into their portfolio.
Thanks for joining us today. If you want to learn more about something in the crypto sphere, please reach out to us at lightbulb@valkyrieinvest.com. You can also find us on Twitter, Instagram, LinkedIn, Facebook, and YouTube. The opinions presented herein are solely of the individual and not necessarily representative of Valkyrie Investments Inc. and their affiliates. There is no guarantee that any specific outcome will be achieved. Investments may be speculative, illiquid, and there is a risk of total loss of your investment. Past performance is not indicative of future results.